The Reserve Bank of Australia is flying blind. We've got new research from Commonwealth Bank showing the lag effect between rate hikes and when consumers feel the pinch. It's absolutely staggering and it's not what you think. The lag time is much longer than what we thought. And we're also going to look at the areas that have been hit hardest across Australia with the recent rate hikes and the fastest fall in values. Let's take a look and see. The Reserve Bank of Australia is flying blind according to CBA. And what CBA has said that we've already had 4 stiff rate rises and it seems highly likely that we're going to have another shot on Tuesday where the Reserve Bank meets and is going to increase the cash rate by another 0.5%. Now, CBA has used an analogy and likened it to being at a party, having 4 shots of vodka and now taking the 5th, not feeling any effects, going, we're absolutely fine. Nothing to see here, guys. Everything's going very smoothly. Now, what we're starting to see is housing has felt some of the effects. We've seen an 8.5% drop in July, but consumer sentiment is still up. We're seeing consumers queue to buy flat screen TVs and cars, and housing consumption, which actually forms 60% of the country's output, has actually hit a new record level of $35 billion in sales in July, which is absolutely nuts. These rate hikes are actually meant to have an effect on consumer spending. We've got data on this that we'll go through in a minute to show you that lag effect and where the Reserve Bank is actually going wrong. Now, the CBA chief economist, Gareth, said it's like having 5 shots of vodka in an hour and saying everything's okay, but you know there's going to be a big effect soon, and the RBA is going to need to put a pause in the not too distant future and actually see the effects of what's actually going on because there's a lag in the data and they're flying blind at the moment. Having a look at the prices and values and changes across the state, we can see literally pretty much everywhere except Perth and Darwin going down this month. We can see cumulative returns in Sydney down 0.8% for the year. We can see Brisbane still up 16% in terms of annual growth, ACT down, Hobart up still, but we can see that these are starting to have an effect, albeit a lagging effect. Now, going on to that lagging effect and what we're seeing, it's a 3-month lag effect is what they're sort of saying, the Reserve Bank's impact in terms of when they move the cash rate up and how that follows on borrowers' cash flow. Now, home borrowers have barely felt the impact of the RBA's rapid 1.75 basis point tightening since May, as their cash flow is really not felt it specifically. There's an average 3-month lag between the RBA rate hike and when CBA borrowers on a variable rate expect to have that affect their home loan repayment. So that's interesting. From when the Reserve Bank actually comes out and says there's a rate hike between when the bank passes it on, when the borrower actually has to fork that money out, there's 3 whole months between when the Reserve Bank comes out and says there's a rate hike and when it actually affects the consumer. What that means is we've seen 4 rate hikes since May this year. Borrowers only really feeling the effect of the first rate hike of 0.25%, which happened in May. Now, the large lag explains why the official spendings data has remained strong and consumer sentiment sits at levels associated with recession and major negative economic shock. So we're seeing consumer sentiments down, but the spendings is up. As we talked about earlier, we saw record levels of spending. We saw $35 billion of sales in July. The Reserve Bank's going, well, what's going on? Why are people still spending? Well, here we have it. Commonwealth Bank saying it takes 3 months for borrowers to feel the effects. And we expect consumer spending will slow down materially as the lag of the impact on the cash rate hits borrowers. And it's widely expected, we've talked about it before, in September, the Reserve Bank, when they meet up, they're expected to increase the cash rate by 0.5% or 50 basis points. So that's this Tuesday that it is widely expected that that's going to happen. And that means that the cash rate will have increased by 2.25% just over 4 months alone, which is absolutely crazy, It's unbelievable how much that's changed in such a short period of time. It took them 4 years to get the cash rate down from 1.75 to 0.1%. Now, in a matter of 4 months, we've gone up by 2.25%. Now, CBA being Australia's largest lender, they account for over 25% of mortgages, and the mortgage market actually said that this means that the bulk of their borrowers have only felt the impact of one rate hike in terms of a cash flow perspective. So if we look at this chart here, we can see on the 4th of May, the Reserve Bank increase their rate by 0.25%, 25 basis points. And in the first month, the bank had to recast their minimum monthly repayments, and they had to update things in the background. From there, they had to give their customers 32 days notice. So they had to give a notice period. So they send everyone a letter. That took another month. And then only on the third month, a month after, it can take greater than a month, they've got to wait till the borrower's next repayment is due. So that could fall anywhere in that month or the month after. What that means is that May rate hike has had zero impact on borrowers up until this August, when their monthly repayment is due. And that's where we've seen the spendings data completely continue to go crazy. We've seen the sentiment at record levels of low, but people are still spending, and we can see why this is a massive impact. Now, as we can see here, we've seen a number of hikes really since May this year, and we've seen some really outsized hikes, 3 in the last 3 months, and potentially another 4th in September. And what the knock-on effect is we've seen new home loans fall at the second fastest rate in the last 20 years. So new home loans have sharply fallen for the second fastest rate in over 2 decades. They plummeted by 8.5% in July, and we're seeing, based on lending indicators, new home loan commitments seasonally adjusted, how that is happening. And, whilst that's all going on, we're seeing consumer CPI, consumer price index, still registering at 6.1. They're saying that's going to get to about 7.8. But it makes a lot of sense. There's a lagged period between when these adjustments are made and when it actually has an effect on borrowers' bottom line. In terms of areas with all these rate rises, we've seen Sydney, Melbourne, even Brisbane, Adelaide, starting to subdue the markets going down. We can see the areas that have had the biggest impact. So we can see the northern beaches, which is fairly common. We see the higher ends of town go down first. They're like the canary in the coal mine. So we can see northern beaches in Sydney. A number of them here have all reduced by about 11%. We can see some other areas in North Sydney and Sutherland going down as well. So we can see the 5 areas in Sydney which have had the biggest reductions in terms of price and negative going backwards. We can see in Melbourne, the Mornington Peninsula and Northeast, once again, the higher ends of town where the higher average price is reduced by about 9.7 to 8.9. Same thing in Brisbane. We've seen Wilston, Hawthorn and Mackenzie, both inner city and south areas, on the upper higher ends of the costings go down. But once again, we've got to remember these areas had massive impacts of growth. We can see, only in the last 12 months, we've seen 16% increase. That coming down. Adelaide as well, we're seeing same sort of thing there, where the higher costs for Central Hills and surrounding suburbs are starting to go down. Perth as well, probably a little bit more affordable, but we can see in a Swanbourne inner, at median price around that $2 million range, coming down 3%. Hobart as well, coming down a little bit. Darwin, Canberra. So we can see there's a bit of an impact in terms of values. The upper end of town always seems to be the first hardest hit, and then the rest of the lower to medium costs come with it. Guys, here at Hunter Galloway, we work with home buyers. We're mortgage brokers based in Australia. So if you need any help, hit us up on 1300 088 065, and we'll see you next time.